Welcome back to the deep dive. You know the drill, we filter the sources, you get the essence. Today, we're mixing it up a bit. We're going to do a quick review, kind of a highlights reel, of some key fintech topics we've explored before.
Exactly. A refresher, really. Whether you're a longtime listener or just want a fast-track understanding, we'll hit the core concepts. Think modern finance foundations, digital assets, the big stuff.
Perfect. Our mission today, a rapid but insightful recap. Connect some dots, maybe.
Let's do it. Where should we start?
Okay, let's dive in with the big one, fintech itself. When we talk about fintech, what are we really talking about?
Well, fundamentally, fintech is this, synergy. It's where traditional finance meets modern technology firms. And that combination is what sparks all the innovation in financial services we're seeing.
Synergy. Okay, so it's not just startups trying to take over.
Not always. No, I mean, lots of startups are trying to disrupt using new tech, definitely. But you also see players building on, well, the existing financial rails, just in smarter ways. They don't always need to reinvent everything from scratch.
Interesting. And fintech isn't brand new, is it? It has a history.
Oh, absolutely. It goes way back. Think about ATMs, right? 1967. That changed how we got cash, challenged bank hours. That was fintech for its time.
Huh. I never thought of ATMs that way.
Then you had SWIFT in the 70s, standardizing global financial messages. Online banking popped up in the 80s. And then the 90s, internet, boom, boom. Online trading, PayPal, digital payments really took off.
Right. PayPal feels like ancient history now, almost.
Doesn't it? But each step was a major shift. Then things really accelerated after the 2008-2009 financial crisis.
How so?
Well, there's a huge loss of trust in traditional finance. People wanted more transparency, maybe more control. And that climate really paved the way for things like Bitcoin, this idea of decentralized systems.
Okay, so the crisis was a catalyst.
A major one. Fintech started acting as a real disruptor, driving financial inclusion for people left out before, improving efficiency, cutting costs, changing what we as customers expect, and even forcing collaborations between the old guard and the new tech players.
And that disruption led to all sorts of different fintech types, right?
Exactly. We've seen so many emerge. You've got your digital payments, like we mentioned, PayPal, mobile money, that sort of thing. Online lending platforms, often using AI for, faster credit decisions. Digital asset platforms, crypto exchanges, basically.
Right.
Then there are neobanks, the branchless banks, and the whole world of DeFi, decentralized finance. We're just trying to rebuild finance on the blockchain.
Let's pause on neobanks for a second. We've covered them before, but give us the quick lowdown again.
Sure. Neobanks are digital-only banks. No physical branches. This usually means lower overheads for them, so they can often offer better rates or lower fees.
And they just operate independently.
Mostly they partner with traditional licensed banks behind the scenes for the core banking stuff. Their main focus is usually on the user experience, making everything super smooth and easy on your phone or computer. Revolut's a big example.
Right, Revolut. Though, as we discussed, they've had their issues too, haven't they, with compliance?
They have. Fines for KYCAML stuff. It's a good reminder that even the tech-savvy players have to get the fundamentals right. Regulation is still key.
And what about microfinance banks, MFBs? How do they fit into the fintech picture?
Yeah, MFBs might not be as flashy, but fintech has actually had a really positive impact on them. Tech solutions help them reach more people, especially in underserved areas, and offer services more efficiently. So it's a favorable transformation for them, too.
Okay, so we have different kinds of banks. But what about the actual movement of money electronically? Who handles that? PSOs and PSPs?
Exactly. Payment system operators, PSOs, and payment service providers, PSPs, they're the crucial plumbing. They provide the platforms for clearing, processing, routing, basically making electronic transactions happen.
So like the wires behind the scenes?
Kinda, yeah. They operate payment gateways for online shops, run payment schemes like card networks, manage clearing houses that settle money between banks, and operate the ATM and POS networks. Think OneLink or NIFT. Here in Pakistan, they're authorized examples.
Got it. And they don't actually hold my money, right?
No, that's key. They aren't banks. They don't act as custodians. They're focused purely on facilitating the payment process itself.
Makes sense. Okay, shifting gears a bit into the crypto world. Stablecoins. What's the essential thing to grasp about them?
Stablecoins are crypto assets designed to hold a steady value. Usually they're pegged to something like the US dollar.
So unlike Bitcoin, which can go way up or down.
Precisely. The goal is to combine crypto benefits like faster, maybe cheaper, cross-border payments and blockchain security with the price stability of, regular money.
How do they maintain that stability?
Different ways. Some hold reserves, like actual dollars or other assets, supposedly backing each coin. Others use algorithms to automatically adjust the supply to keep the price stable.
Okay. And you get them on crypto exchanges.
Yeah, typically you exchange fiat currency, like dollars, for them on trading platforms. But, and this is important, the quality and transparency of those reserves can vary a lot.
So not all stablecoins are equally stable.
Definitely not. There aren't universal standards yet. Your right to actually redeem the coin for the underlying dollar, for instance, might not always be guaranteed. So stability really depends on the specific coin's design, the reserves, and how much you trust the issuer. Plus, the market's quite concentrated. Just two big ones often dominate.
Like USDC.
Right. USDC is a big one. It's fiat-backed, and they try to be transparent with audits of their reserves. Trust in the issuer is crucial.
Okay. So stablecoins try for stability. What about just crypto? The broader term.
Crypto, short for cryptocurrency. Digital or virtual currencies secured by cryptography. Bitcoin, back in 2009, was the pioneer. Built on blockchain, decentralized, using something called proof of work.
And the appeal.
Potential independence from, say, government control is one aspect.
Yeah.
But they face hurdles. Scalability, handling lots of transactions quickly can be an issue, and some cryptos, especially proof of work ones, use a lot of energy.
And the price swings.
Oh yeah. Highly volatile. Driven by sentiment, speculation, hype. Makes them tricky to use as a stable store of value, or for everyday payments. They're definitely prone to bubbles and crashes.
Which brings us to the technology underneath a lot of this blockchain. Can you demystify that for us again quickly?
Sure. Think of it like a shared digital notebook or ledger, but instead of being in one place, copies are spread across many computers in a network.
Distributed, right.
Exactly. Data gets recorded in blocks, and these blocks are linked together cryptographically to form a chain. To change anything in an old block, you'd need to redo all the blocks after it and get most of the network to agree. That makes it really secure and tamper-evident.
So like a chain of locked digital files.
That's a decent analogy. Each block has data and a unique digital fingerprint, a hash, that also incorporates the hash of the block before it. Changes are obvious.
And how do new transactions get added?
Through a consensus mechanism. Basically, multiple computers or nodes in the network have to agree that a transaction is valid before it gets added to a new block on the chain.
Like proof of work.
Right. Bitcoin uses proof of work. It's like a computational race. Miners solve complex puzzles, and the longest chain represents the most work done, making it the accepted version of history. Very hard to cheat.
But energy intensive.
Very. That's why others, like Ethereum now, use proof of stake. Validators are chosen based on the coins they stake or lock up. It's much more energy efficient.
Can blockchains be private?
Yes, you can have permission blockchains for specific organizations. Good for sharing private data securely within a group, but it does reduce that full decentralization aspect. Cryptography hashing, public-private keys is absolutely fundamental to securing everything on any blockchain.
So beyond crypto, blockchain has other uses.
Huge potential, yeah. Secure, transparent record keeping is useful in supply chains, healthcare, voting. Lots of areas are exploring it. Conceptually, you have the core blockchain layer, then edge tech like wallets and APIs to interact, and application layers like smart contracts on top.
Okay, putting these pieces together, fintech firms, banks, blockchain, how does the overall structure typically work?
Often, it's this synergy again. You might have a licensed bank providing the actual regulated service, but a tech firm provides the app, the platform, the innovative features. It's a partnership.
And in DeFi?
DeFi is a bit different. It's more layered. You've got the base settlement layer, which is the blockchain itself, then a smart contract layer with protocols defining financial products, lending, trading, etc. And finally, the user application layer, the websites or apps you use to interact with those protocols.
Got it. Now, a term that sometimes pops up, especially with international payments, Nostro accounts. What are those about?
Nostro accounts. They're part of correspondent banking. Basically, if Bank A needs to make payments in euros, but doesn't have a branch in Europe, it might hold an account at Bank B in Europe. That account Bank A holds at Bank B, denominated in euros, is Bank A's Nostro account.
Okay, and the risk?
The risk is if Bank B, the Nostro agent holding the account, gets into trouble, financial difficulty, insolvency, whatever, that could disrupt Bank A's ability to make those euro payments. Bank A might have to quickly find a new bank, a new Nostro agent.
So it's about counterparty risk between banks.
Exactly. And sometimes big settlement systems like CLS, which handles huge volumes of foreign exchange, might ask participants for extra funds, a pay-in call. Both the Nostra client, Bank A, and the agent, Bank B, need to be ready and able to cough up that liquidity.
Understood. Okay, let's circle back to decentralized finance, DeFi. You mentioned it earlier. What's the core idea there?
DeFi aims to recreate traditional finance lending, borrowing, trading, but using smart contracts on decentralized networks. The big idea is to cut out the traditional middlemen, the banks, the brokers, the payment processors.
How does that work?
Automation via smart contracts. These are bits of code on the blockchain that automatically execute agreements. This can potentially lower transaction costs because there's less overhead. You have decentralized exchanges, DEXs, for direct peer-to-peer crypto trading.
So bypassing the usual institutions.
That's the goal. Also, promoting financial inclusion, giving people access just through a smartphone and internet, potentially without needing traditional bank accounts or credit history for some services. Platforms like AA or Compound let you lend or borrow crypto directly.
And stablecoins are important here.
Very important. They provide that stable medium of exchange and store of value within the often volatile DeFi ecosystem. Makes things like lending more predictable.
But it sounds risky.
Oh, definitely. DeFi comes with significant risks. Technology risks are huge bugs in smart contracts that hackers can exploit. Network attacks, unreliable data feeds, or oracles messing things up. We saw that with the massive Ronin network hack, right? $625 million. Or the Wintermute hack. Sometimes chasing scalability can compromise security.
Wow. And legal risks.
Big ones. The regulatory landscape is still very uncertain for DeFi in most places. Who's responsible when something goes wrong in a decentralized system? How do you apply anti-money laundering, AML, or KYC rules when users might be pseudonymous? It's challenging. And yes, the potential for illicit finance, money laundering, is a real concern due to that anonymity and lack of registered entities in some cases.
Which leads us perfectly into the final crucial area: security, compliance, and avoiding scams. Let's start KYC and due diligence first. Why are they so non-negotiable?
KYC. Know your customer and due diligence are fundamental. They're regulatory requirements designed to prevent financial crime, money laundering, terrorist financing, AML/CFT regulations. Fintechs have to comply.
And if they don't?
Hefty fines, serious reputational damage. We've seen big names get hit: Revolut, Wise, Block, Klarna, for failures in their KYC or AML processes.
So how are fintechs handling this?
They're using tech, increasingly. Digital ID verification, AI, and machine learning for faster checks, and risk scoring during onboarding. Some are looking at blockchain for identity solutions, too. The trend is towards perpetual KYC ongoing monitoring, not just a one-off check, and more agile compliance systems that can adapt quickly.
Why do failures happen?
Various reasons. Sometimes it's just breaking the rules. Other times, ineffective verification, poor record keeping, not properly identifying who ultimately owns or controls an account, relying too much on manual processes, or simply not understanding the risks well enough. Plus, balancing speed with security is tough, global regulations are complex, and keeping up is a constant challenge.
Okay, now the really nasty stuff. Ponzi schemes and fraud. What should people watch out for, especially with crypto?
Ponzi schemes promise ridiculously high, guaranteed returns with little risk. The classic sign is they pay early investors with money from new investors. It always collapses eventually.
Red flags.
In crypto Ponzi's, lack of transparency about how they generate returns. No independent audits, weird account statements, being unlicensed, difficulty withdrawing your money. And a big one, the promoters living incredibly lavish lifestyles even when the company's brand new. Be super wary of guarantees of like 1% or more per day. We saw that with fake liquidity mining scams.
Like that MTI scheme.
Exactly. Mirror Trading International hit all those notes, claimed no registration fee, full transparency, proven track record, promised easy passive income. All classic Ponzi tactics.
And other types of fraud.
Plenty. Account takeovers, payment fraud, identity theft. Investment scams are huge. There's that awful pig butchering scam where they build trust over weeks or months, get you to invest more and more in a fake platform, then disappear with everything.
Horrible.
Yeah. And ransomware attacks, like Reseda, target financial institutions, too. Financial fraud often crosses borders, making it harder to tackle. And money laundering is still an issue in crypto, using mixers to hide transaction trails or services with weak compliance or darknet markets. Regulatory differences between countries don't help either.
So, given all these risks, what are the key takeaways for staying safe?
Number 1, if it sounds too good to be true, guaranteed high returns, zero risk. It probably is too good to be true. Run away.
Healthy skepticism.
Absolutely. Do your own research, proper due diligence before putting money into any platform, fintech or crypto. Understand why companies do KYC. It's partly for your protection, too. Be incredibly cautious about unsolicited investment advice, especially online or from strangers.
Verify everything.
Verify legitimacy, check licensing, learn the red flags for Ponzi's and fraud we talked about, and guard your personal and financial information very carefully online. Basic digital hygiene is crucial.
That is vital advice. Okay, wow. We have definitely covered a lot of ground today, revisiting these key fintech and digital asset concepts.
Yeah, it was a quick tour, but hopefully a useful one. Just connecting those dots from our previous deep dives and giving a solid overview.
I think it was. Hopefully this review gives you a clearer picture of this evolving landscape. Keep these fundamentals in mind as you navigate it all.
And remember, you can always go back to our earlier deep dives for more detail on any specific topic.
Absolutely. And we're not done yet. We have more in-depth explorations planned for you in our next series, so definitely stay tuned for that.